Fibonacci is one of the most important studies when it comes to technical analysis. It helps us to understand how much a stock can pull back in an uptrend, and at the same time it also helps us to find important levels where we can enter a stock. Now, to understand Fibonacci, we first need to understand trend. And to explain trend, I'll be explaining through a simple concept of Dow theory. An uptrend is when a stock is making continuous higher highs and higher lows. A downtrend is simple when a stock is making lower highs and lower lows. And a sideways market is when a stock is making relatively same highs and same lows. This gives us a clear understanding of what a trend is. Now, the best part is Fibonacci helps us to understand how much does this pullback happen. We need to understand that a way the stock behaves in an uptrend is very different compared to a stock. How it behaves in a downtrend is very different. So let me briefly explain how the behavior changes according to the market. Now, if you are in an uptrend, what you will see is the pullbacks are shorter in nature. They don't have very much depth. At the same time, when a rally happens, it happens in a slow format. Same way, again a pullback happens, slower pullback. When a rally happens, again slow rally. Now, when we switch the trend to a downtrend market, the behavior completely changes. The falls become more rapid and the rally becomes much more sharper. So many times you would have seen that a bear market, the sharp is very fall and the pullback is also very sharp. So this is a very typical behavior when it comes to a downtrend market. Now, where does Fibonacci come in on this? Very simple. In an uptrend, due to the nature of how uptrend works and the smaller pullbacks, generally a very strong bull market will not see a deeper correction than 38%. And when you're in a bear market, you will notice that corrections are generally coming towards the 61 and 78% mark. So let me give a simple example to understand. Now, if a rally happens of 100 points, generally you can expect this following pullback to be in the range of 23 to 38 points. And in a bear market, if you see a, let's say, 200 point fall or a 100 point fall, you can generally expect the pullback 61 to 70 point pullback. So this clearly helps us to understand what type of retracement to use at which market. Let us understand Fibonacci retracement with a simple example of Nifty. Now, in Nifty, we had a fantastic rally that started around the 16,000 mark, 16,800 mark, and from there we saw a rally close to the 17,700 mark. Now, observe very closely what has happened in this fall. We had 3 to 4 days red day, and it has exactly stopped at the 1,700 retracement mark, and you had a fantastic confirmation here with the green candle. Now, if you see the next rally, what happened? Great rally. After a great rally, we had a pullback, and if you notice where the pullback stopped, it stopped at the 0.382 mark, exactly here, and this pair was a perfect confirmation to enter the trend. Now, let us see the next example. We had a long rally with hardly any pullbacks, and if you see what has happened on the next pullback, the next entire pullback, you can see that the pullback stopped exactly around the 0.38 mark here. And this gives a clear understanding that the uptrend is still pretty strong. And if you just draw a trend line from here, this candle confirmation is a perfect entry point into that trade. Now, you will see something very interesting happen in the next rally. If you see what has happened in the next rally, market rallied, broke the high, still respecting parameters of uptrend. But if you see the depth of this correction, the depth of this correction is close to 0.786. So that means that this is a weaker bull market. And in a weaker bull market, what happens is that rallies are generally not able to sustain to the next high. This gives a clear understanding that this is not an area where you want to enter Nifty. This type of understanding is what you get from Fibonacci retracements. Now let us understand how downtrend works. Downtrend, we have discussed that a fall is very sharp followed by a sharp rally or a very tight consolidation. Now let us observe the same behavior in the chart. For example, we are taking UPL chart because it's a bearish market. Now if you see the fall is extremely sharp. Within few days we saw major correction, and after major correction, if you see, the rally was extremely weak and not sustaining, and it exactly came to 0.38 levels and saw a major sell-off. Now let us observe the next fall. The next fall, within a few weeks, we saw a major correction, and after a major correction, if you just observe what happened to the rally, it came exactly to the 0.5 to 0.6 range, and from here we saw a major sell-off. Now if you see the next fall, very fast selling. After very fast selling, you saw a sharp pullback, and this pullback exactly stopped around the 0.78 levels, and now we are seeing another fall in the market. Now we can expect this rally to also have a 0.6 to 0.7% pullback. This is how we use Fibonacci levels to identify where to trade and how to trade, and it makes it extremely easy to enter a trend in the market.